The concept of a no-usury monetary system, where loans bear no interest or exploitative return, is a persistent myth propagated by scholars and ideologues to project moral superiority or intellectual prowess. Historical claims of usury-free economies, spanning Nazi Germany, Islamic finance, medieval Christian Europe, and other experiments, are riddled with contradictions, revealing hidden obligations that often surpass the exploitation of explicit interest. Systemic no-usury is unattainable due to human nature's greed and opportunism, which inevitably introduce coercive repayments such as labor, social pressures, or disguised fees. Only small-scale, private loans among trusted individuals escape this trap, though they remain fragile and unscalable. This essay contends that so-called no-usury systems are facades, masking abusive practices under ethical or religious guises, driven by intellectual dishonesty and profiteering. Scholars glorify these systems to sell books, subscriptions, or ideologies, cloaking arguments in complex terminology to appear authoritative. Beneath the surface, each system reveals a pattern. Proclaimed no-usury devolves into obligations that bind debtors in ways akin to, or worse than, traditional usury. Nazi Germany's regulated interest, Islamic finance's social pressures, and medieval Europe's feudal ties exemplify this deceit. Human nature, driven by self-interest, ensures that lenders demand compensation, whether through interest, labor, or prestige, rendering systemic no-usury a rhetorical illusion. The $4 trillion Islamic finance market and myths of Nazi economic miracles fuel academic and commercial hype, yet scrutiny exposes their reliance on hidden usury. This essay examines 4 case studies: Nazi Germany's monetary reforms, Islamic finance's historical and modern practices, medieval Christian anti-usury laws, and other experiments like Wurgel and colonial scrip, to demonstrate their hidden usury. Each section reveals how these systems, despite anti-usury rhetoric, imposed alternative burdens that often exceeded the harm of explicit interest. The analysis culminates in a conclusion affirming that only private, trust-based loans achieve no-usury status, while systemic attempts are inherently flawed, driven by ideological agendas and human greed. This critical perspective unmasks the intellectual dishonesty of scholars who champion these systems, exposing their true nature as exploitative mechanisms veiled in moralistic rhetoric. Part 1. Nazi Germany's monetary facade. Nazi Germany's monetary system, heralded as a break from Weimar's debt-ridden chaos, exemplifies the deceit of no-usury claims. Post-1933, Adolf Hitler and Reichsbank President Hjalmar Schacht transformed the Reichsmark-based economy, promising to abolish interest slavery as outlined in Gottfried Feder's manifesto. The Weimar system, burdened by reparations and interest rates up to 15%, collapsed into hyperinflation and 30% unemployment by 1932. The Nazi regime introduced Mefo bills, promissory notes issued by a shell company to fund rearmament at a regulated 4.5% interest rate, hidden from public debt records to evade Versailles Treaty scrutiny. By 1939, national debt reached 40 billion Reichsmarks, with Mefo bills comprising 60% of bonds, repaid through taxes and wartime plunder. This system, though functional, was not usury-free. The 4.5% interest on Mefo bills and state loans contradicts no-usury rhetoric, revealing propaganda to mask state-driven financing. High unemployment fell from 6 million in 1933 to near zero by 1938, and increased consumer spending, with retail sales rising 20%, masked this deception as wages circulated money without heavy personal debt. State-controlled debt and reliance on looted gold and forced labor reveal exploitative underpinnings. Scholars glorify this as an economic miracle, but the system's reliance on hidden usury and coercive repayment, worse than transparent interest due to opacity and war-driven unsustainability, is evident. The collapse by 1945 underscores its fragility, driven by greed in state and industrial elites who profited from regulated interest and plunder. The anti-usury narrative was a facade to rally against Jewish finance, while practical needs forced interest-based financing. This mirrors the broader pattern of systemic no-usury failures, where ideological promises crumble under economic realities. The Nazi case demonstrates that even a centralized, state-driven economy cannot escape usury's grip, as human nature demands returns, rendering scholars' praise hollow and self-serving. Part 2. Islamic finance's deceptive no-usury claims. Islamic finance, rooted in Sharia's prohibition of riba, presents another case of illusory no-usury. Historically, from the 7th to 19th centuries, Islamic economies were decentralized, using gold dinars, silver dirhams, and barter with livestock or produce. Qard Hasan, an interest-free loan, required only principal repayment, but social pressures for gifts often mimicked usury. Modern Islamic banking, formalized in the 1970s, uses profit-sharing models like mudaraba, which resemble interest due to structured returns. Al-Rajhi Bank's 2022 report shows Qard Hasan as only 0.5% of assets, with profit-sharing dominating, revealing a focus on returns over charity. External borrowing from Western banks at interest, such as Ottoman loans at 6 to 10% in the 19th century, was kept separate to maintain internal no-usury claims. Post-1973, oil wealth. Saudi Arabia's GDP grew from $14 billion in 1970 to $164 billion in 1980, reduced borrowing needs, as Western investments in oil infrastructure provided capital without interest. This allowed Islamic nations to uphold the no-usury facade while accumulating wealth, but profit-sharing and fees persisted as usury's proxies. Social pressures for gifts and power imbalances in profit-sharing create burdens akin to debt slavery, often less transparent than interest. Scholars champion Islamic finance's ethics, but this is intellectual posturing to sell certifications or books. The $4 trillion Islamic finance market in 2023 fuels academic and commercial hype, yet deviations, such as Malaysia's 2018 Tabung Haji scandal, expose mislabeled usury. Human opportunism undermines no-usury. Lenders, even in Sharia systems, seek returns, making systemic no-usury unattainable and scholarly claims disingenuous. Part 3. Medieval Christian and other historical facades. Medieval Christian Europe's anti-usury laws, enforced by the Catholic Church from the 5th to 15th centuries, further illustrate the deceit of no-usury systems. Canon law banned interest, citing biblical mandates, but lenders used loopholes like penalties or inflated credit sales. Debtors, often peasants, faced labor or land obligations, resembling slavery. These unwritten deals, driven by feudal power imbalances, were more abusive than explicit interest due to their opacity and coercion, confirming that such systems are worse than transparent usury. The Wurgel experiment in 1932 Austria, using demurrage script to discourage hoarding, reduced unemployment by 25% but required repayment via taxes or labor, a quasi-usurious burden. Human nature drives opportunism. Some hoarded goods or influence, and local elites controlling scrip exploited power, undermining non-hoarding claims. Colonial American scrip, issued in the 17th to 18th centuries, offered low or no interest but tied repayment to goods or taxes, binding debtors to elites. Ancient Athens' public loans demanded social prestige, creating dependencies akin to usury. Each system, despite no-usury rhetoric, imposed alternative burdens, labor, taxes, or loyalty that were exploitative due to their covert nature. Scholars glorify these systems to push anti-banking narratives, selling books or courses, ignoring how human greed subverts non-hoarding ideals. The pattern of intellectual dishonesty is clear. These systems' hidden usury, driven by opportunism, exposes the emptiness of claims championing them as ethical alternatives. Part 4. The impossibility of systemic no-usury. Systemic no-usury is impossible due to human nature's greed and opportunism. Nazi Germany's 4.5% interest, Islamic finance's profit-sharing, medieval Europe's feudal obligations, Wurgel's tax-based repayment, colonial script's goods-based burdens, and Athens' social expectations all reveal disguised usury. These systems, while claiming to eliminate interest, impose alternative repayments, labor, gifts, or taxes that often exceed the harm of explicit interest due to their lack of transparency and potential for abuse. Human nature drives hoarding and exploitation, Even in Wergel's anti-hoarding system, elites stockpiled resources and Islamic lenders expected social gifts, mirroring usury's effect. Private, trust-based loans among individuals remain the sole exception. These small-scale, short-term arrangements, often unwritten, expect only principal repayment, free of institutional agendas. Their fragility, risking ruined relationships, and unscalability limit their viability. Systemic economies require credit, and lenders demand compensation, whether through interest, labor, or prestige, making pure no-usury unattainable. Scholars and influencers, from medieval theologians to modern Islamic bankers, peddle no-usury myths to sell ideologies or products, cloaking motives in complex rhetoric. This pattern of intellectual dishonesty reflects human opportunism. Scholars profit by promoting utopian systems, ignoring flaws to maintain relevance or sell subscriptions. The $4 trillion Islamic finance market fuels certifications, while Nazi myths persist on platforms, feeding anti-banker sentiment. Systemic no-usury is a facade, undermined by the greed that drives lenders to exploit debtors, making private loans the only true, albeit limited, no-usury model. Conclusion: hidden exploitation in historical no-usury monetary systems. The historical record of so-called no-usury systems, Nazi Germany, Islamic finance, medieval Christian Europe, Wergel, colonial scrip, and Athens, confirms that these are facades masking exploitative practices, often more insidious than explicit interest. Each system, despite anti-usury rhetoric, imposes alternative burdens, labor, taxes, social pressures, or profit sharing that replicate or surpass usury's harm. Nazi Germany's 4.5% MEFO bills, Islamic finance's gifts and profit sharing, medieval Europe's feudal ties, Wergel's tax obligations, colonial script's goods-based repayment, and Athens' social expectations reveal hidden usury driven by human greed and opportunism. These systems are worse than transparent interest. Their lack of clarity and power imbalances enable abuses akin to debt slavery, as seen in medieval peasants' labor or Islamic social pressures. Scholars and experts perpetuate these myths to appear authoritative or profit from books, courses, or ideologies. By glorifying flawed systems with complex terminology, they obscure the truth. Systemic no-usury is impossible because human nature demands returns, whether through interest or disguised obligations. Even anti-hoarding experiments like Wergel fail, as opportunists hoard resources or power, and enforcers exploit most. The $4 trillion Islamic finance market and Nazi economic miracle myths exemplify this intellectual dishonesty driven by commercial or ideological agendas. Only private, trust-based loans among individuals, typically small-scale and short-term, achieve true no-usury, expecting only principal repayment. Yet, these are fragile, risking relationships, and unscalable for systemic needs. The broader point, that experts peddle nonsense to sell anti-banking solutions, is irrefutable. These systems' failures, from medieval exploitation to Nazi war-driven collapse, expose the futility of systemic no-usury. Human nature's greed ensures that lenders, whether governments, banks, or elites, impose burdens, rendering no-usury claims a deceptive veneer. This critical examination affirms that no-usury is a myth, and only private loans escape its grasp, while experts' grandiose claims serve only to enrich themselves at the expense of truth.